Relative Strength Index, RSI. The RSI is a momentum oscillator designed by Wells Wilder. The oscillator fluctuates between 0 and 100. RSI measures the average gain in prices relative to the average loss and outputs the information to a number between 0 and 100. The input parameter is the number of periods used in the calculation. Wilder recommends a period of 14. So for example, for a period of 14 days, if the average up is greater than the average down, then the RSI indicator will increase. If the average down is greater than the average up, then the RSI indicator will decrease. Although you don't need to know this, the actual calculations for the RSI is posted on our website. Wilder recommends that RSI values over 70 are considered overbought, too expensive, and RSI values under 30 are considered oversold, too cheap. As a tip, when a security is in a strong uptrend, buying in an oversold condition is a better strategy than selling in an overbought condition. Similarly, in a strong downtrend, selling when the security reaches overbought conditions is a better strategy. So here we have an example of the RSI. Now values over 70 are considered overbought, and values below 30 are considered oversold. So we see that the RSI has broken through the 70 barrier into the overbought territory, which is caused by this dramatic price increase in the security. Now prices can remain overbought for a long period of time. The key is to wait for the RSI value to drop below 70, and that will give us an alert to enter the market. So in this case, we're going to sell first and buy back later. So we're going to short. On the other hand, in an oversold condition, we want to wait for prices to break above 30, and that will give us an alert to enter. In addition, we have negative divergence forming on the RSI. We have the RSI values going down, while the prices in the securities are moving sideways. So this is giving us an early alert that prices will fall. This is why the RSI is the leading indicator, because it tells us in advance that prices will decrease, which they do, as seen here on the graph. A simple and effective way to generate signals is to look for when the RSI crosses the upper or lower bands. A buy signal is generated when a security is oversold and the RSI moves up above 30. A sell signal is generated when a security is overbought and the RSI moves down below 70. Combining the above techniques with divergences gives us an even stronger buy and sell signal. So we're going to talk about divergence. The concept of divergence is important when using indicators and oscillators. Divergence can alert us on when a trend is about to change. It gives us an early signal on when to buy and sell a security. So we have positive divergence, and this is when the indicator is increasing, but the underlying security is decreasing. And we also have negative divergence. The indicator is decreasing, but the underlying security is increasing. So here we have live cattle, and we see that the prices are decreasing dramatically. The RSI values are also decreasing, breaking through the 30 barrier into the oversold territory. We also see a positive divergence forming on the RSI. So we have RSI values going up while the prices continues to go downwards. So the RSI is giving us an early alert that prices are going to reverse. The RSI is telling us that prices will eventually increase. So we wait until the RSI breaks above 30, and this will give us a buy signal. So we have a buy signal here, and prices eventually increase as they do here on the graph. So securities can remain at oversold or overbought conditions for long periods of time. At overbought conditions, look for a negative divergence as an alert to sell. In other words, securities prices are rising, but the RSI is falling. At oversold conditions, look for positive divergence as an alert to buy. In other words, securities prices are falling, but RSI is rising.